We're focusing on three sectors, three areas today. We're looking at Uganda, Rwanda and Kenya. Let's look at it from an economic perspective. Kenya, we know we've got elections, higher interest rates that are coming through. In Uganda, worries about the overall economic growth because of electricity costs. And then in Rwanda, we're still seeing a few troubles coming through with regards to the overall growth picture. Put it into perspective for us, because this really affects the banking sector by looking at the economic side of things.
Thanks for having me. Well, looking at Kenya specifically, I'm pretty rosy on my outlook for the Kenya macroeconomic environment this year. We are forecasting a strong rebound in GDP growth this year from 4% that 2011 is expected to come into to 6% economic growth this year. The rationale for that is because agriculture is still 22% of GDP in Kenya, and it's dependent on the long rains between March and May and short rains between October and November. October-November short rains were very good, so we expect a rebound in GDP in Kenya this year. For Uganda, we think the manufacturing sector has already seen a slowdown, and that will only be worsened by the impact of the 40% hike in electricity tariffs. For Rwanda, we still expect strong economic growth. However, it could be challenged due to the reliance on donor funding from Europe. Up to 40% of the budget is donor funded.
Well, let's just touch now on those banks within the region. What's interesting to note is that when you look at the price-to-book scenario that is playing out within the African region, we're looking at very attractive ratios, 7.8 with regards to the equity return that we see coming through for these banks. Very attractive right now, but it seems that for good reason, because we have actually seen a lot of troubles in the preceding year.
Correct. I mean, looking at the banks right now, they are trading at very attractive valuations compared to historical levels. We have banks like Equity Bank. Normally, the price-to-book ratio is above 3. Currently, the price-to-book ratio is slightly below 2. We have banks like Kenya Commercial Bank, which has always had attractive price-to-book ratios, and currently the price-to-book ratio is at 1.2. And when you regress these price-to-book ratios against the return on equities, which determine the price-to-book ratios, you still find that these banks, such as Equity Bank and KCB, are trading at a discount to intrinsic value. Looking at a bank like Stanbic Uganda and Bank of Kigali, again, price-to-book ratios of 4 and 1.4 respectively. At least in the case of Stanbic Uganda, we see this is a bank that has traded at price-to-book ratios of up to 6. So really, valuations are looking attractive right now as a result of the bearish environment in 2011.
So what you're actually saying, that price-to-book should actually be at 7.8, not that they are on average at 7.8, because it seems that the numbers that you're talking about far below the levels.
Correct. Actually, the price-to-book ratios are more in the range of between 2 and really they should be at the level of around 3. So that's an upside of potentially in the range of 40–50%.
Let's also just touch on the interest rate environments, and let's just hone in on the likes of Kenya. Given the fact that interest rates are sitting at 18%, we know inflation is very high. This is going to have a significant impact on the banking sector going forward, but it seems that it could be counteracted with the fact that we see strong growth. The truth is that access to funding is going to be quite tough still for the consumer.
Well, I think what's going to happen this year, we've already seen strength in the Kenya shilling and the Uganda shilling. And as a result of that, we expect the central bank to relax its monetary policy. By the end of this quarter, we're expecting a rate cut in the CBR of anything up to 200 bips. The knock-on effect of that is that funding for banks is actually expected to become cheaper as a result of the easing liquidity. So we're actually looking at a year where cost of funds for banks could revert back to normal levels, especially in the second half of the year.
Let's also touch on Rwanda. You were alluding to the fact that we saw quite a big reliance, we do see a big reliance on Eurozone donor funding. What kind of impact could this actually have, and how does this translate into impacting the overall banking sector?
Well, in the case of Rwanda, we've already seen in 2011 banking asset sector growth slowed down a little compared to 2010. Bank of Kigali continued to maintain its strong banking sector growth in terms of asset growth, but that was really going against a trend if you look at the other banks. A slowdown in donor funding as a result of the Eurozone wars could curtail liability acquisition and have a knock-on effect of constraining asset growth as well.
Looking at non-performing loans in Uganda, for example, which is currently sitting at 1.6%, it seems to be lagging their neighbours as well. Let's put it into perspective with regards to the region that you're most optimistic about. Which country are you looking at to offer the best value?
Looking at 2012, I would have to pick Kenya to offer the best value, simply because the macroeconomic environment is looking pretty good right now. We are looking at a situation whereby the Kenya shilling will continue to strengthen, at least for the first half of this year. And also we are looking at a situation whereby we expect interest rates to start coming off, starting from the second quarter of this year. That, coupled with the high return on equities and low price to book values compared to historical levels, makes Kenyan banks pretty attractive right now.
Let's just look at the banks that I know that you're most optimistic about: KCB, Equity Bank, Barclays and Co-op Bank as well. Does this mean you'd be entering these banks right now? Do you advise that we buy the shares of these banks at this level? We know that earnings, of course, are imminent in the banking sector in Kenya.
For KCB and Equity Bank specifically, we have buy recommendations of those. We think they're trading at very attractive levels. And in the region, we also like Stanbic Uganda, DFCU, and Bank of Kigali, all of which are trading at significant discounts to intrinsic value.